What's up guys, it's Nosh here. Today we're going to be talking about real estate versus the stock market. Which one is better? Does real estate offer you a safer investment? Does the stock market allow you to put less money down and grow your money faster? We're going to be touching on these points in this video. So with that being said, let's get started. A little history lesson here. Before New York got its name, it was previously known as New Amsterdam. The Dutch West Indies Company fought long and hard to defend New Amsterdam from the Native Americans as well as the British. However, in 1664, the British eventually conquered New Amsterdam, and that's when they changed the name to New York. The remains of the wall that was built by the Dutch West Indies Company in order to defend its colony from the Native Americans as well as the British is all too quickly forgotten. The battle is really only remembered by scholars. Where such a gruesome battle took place, the rubble is now settled and has been cleared. Since then, the roads have been paved, and instead of the wall stands a 7,100-pound bronze statue of a charging bull, which has become an iconic symbol representing Wall Street. Now, truth be told, I can't even count the number of times I've been in a conversation with somebody and they've tried to convince me that no matter which way you slice and dice it, as far as investment goes, the stock market is better than the real estate market. When I talk to these people, I quickly realize that they've already made up their mind. They're already determined that the stock market is the better place to park your money. And that's totally fine. Truth be told, there's no one size fits all. If you genuinely believe that the stock market is going to be better for you as a form of investing than the real estate market, don't let anybody convince you otherwise. Some believe religiously in the stock market, and within the first few minutes try to throw out numbers to me and show me charts and graphs, pull out online calculators and start talking about PE ratios, PEG ratios, dividends, yields, etc. As well as retiring at the age of 65 or just shy of that. Now at this point I simply give them one of these. Yeah, okay. And the topic quickly changes to something other than real estate versus the stock market, because I can see that their mind is already made up and they're not likely to be receptive to any kind of new thoughts or ideas. The decision to invest in the real estate market compared to the stock market ultimately boils down to one's own individual preference, investment style, comfort zone, and ultimately their knowledge of the two. I will be honest, what I do find a little bit comical if I entertain the conversation just a little bit longer is that the individual I'm speaking to, often at times, they don't have enough knowledge about local or overseas markets in order to determine whether a company is going to be profitable in the next decade or so. Motorola and Nokia, for example, were brilliant companies and they saw a tremendous amount of profits. Anyone who owned a share of Nokia back in 2007 saw the company peak at $40 a share. However, just like that, Apple entered the market, and within 2 years, Nokia was out of the game. Investors who maintained faith in Nokia and held on to those shares, hoping the company would turn around, ultimately ended up suffering significant losses and saw the company drop to less than $10 a share. Now, when you look at retirement potential between real estate and the stock market, real estate has a very realistic and practical ability to provide one with a significant amount of cash flow to cover their monthly expenses, and therefore positioning them in just a few short years to be in a position to be able to retire. After all, who really wants to wait until they're 65 to be able to retire? Would you rather not have several hundred or several $1,000s coming in every month while your net worth continues to rise? And this is a very important point here, which is why when I talk about investing in real estate, I'm almost always referring to investing for cash flow purposes. Investing in income properties that will pay all the expenses pertaining to the property every month and then leave several hundred or several $1,000s in your pocket by the end of the month. Now in the stock market, to achieve the same result, someone would have to invest a substantial amount of more money, or alternatively wait several decades before the dividends would generate the same amount of income. Now this is of course assuming that the market performed optimally and did not fluctuate or go up and down as markets naturally have a tendency to do. With the stock market, you're typically surrendering all control and placing it in the hands of somebody else or another company. Now, of course, granted, there's the S&P 500 and there are companies like McDonald's and Coca-Cola who I can bet my entire net worth will not go out of business if the market crashes tomorrow. However, I have absolutely no control over how they will perform or how to increase their net profits. With real estate, it's your own business. You have full control. What you do today is likely to affect your bottom line tomorrow. And even though the real estate market may fluctuate, your rental income is likely to stay the same. Even in a market crash, people still need a place to live. They still need that essential service and they're still willing to pay for it. They may cut down on travel, gas, eating out, technology, vehicles, and other businesses involved in the stock market. However, their desire for a place to live is likely not to be affected. Investing for cash flow assures you that in the event of a market crash, you're able to ride the wave out to see you through, and that you're not glued to the stock market on an hourly basis to see the amount that you may have possibly just lost. A real estate investor is also able to make use of the many different tax advantages and strategies in order to retain much of the wealth within their investment portfolio. Investing in the stock market leaves you with zero tax advantages. Be sure to check out my video on income-producing rental properties. If an investor wants to see higher returns, then within reason, he or she can make various upgrades, increase the rent proportionally, and once the returns cover the cost of the upgrades, the remainder is profit. With rental properties and investing for cash flow, I don't have to pray that the market does well over the course of the next 30 to 40 years so that I can ultimately retire. I don't have to worry about spending less or living more conservatively in my retirement years just so that I can see myself make it through those golden years. With owning rental properties, I simply need to look at what my monthly expenses are. Then I need to consider how much cash flow I'm generating from, let's say, a single property. Then it's a matter of multiplying how many properties I own to offset my monthly obligations, and once I reach that sweet spot, I'm financially free. At this point, I would be making the exact same amount of money staying at home and doing nothing as I would be if I went out and worked a 40-hour-a-week full-time job. This ultimately means that from a financial perspective, I can afford to do whatever I please. I can invest in further education, take vacations with my family, purchase a franchise, or start my own business to increase my overall income and success. The key here is that within a few short years, you can set yourself up for the remainder of your life, and the only time when the money will stop coming in is when you ultimately go to sell the property or choose to refinance the property. And when you ultimately decide to sell, you would be trading in your regular monthly income from that property for a large lump sum payment. Now, some of you might be thinking, yeah, but you know what, Nosh, when you go to sell that rental property, you're going to have to pay what's called capital appreciation. But now remember, you can offset capital appreciation with capital costs, which is not something you can typically do with the stock market. Now I'm going to take a quick moment to explain this for some of you who may not actually know what that means. Let's suppose you purchased a rental property for $500,000. Several years later, you sold that property for $700,000. But in order to sell it at $700,000, you incurred what's known as capital costs, and that's referring to redoing the kitchen, redoing the bathroom, upgrading the flooring, etc. Now let's suppose these costs amounted to $100,000. It increases the cost of the property to you from $500,000 to $600,000. So now there's only $100,000 left in profit instead. Now you're required to include half of the capital gains in your income, which is then subject to tax at your tax bracket. So in this example of $100,000 left in profits, you would take half of that, i.e. $50,000, and add that to your total income made that year. This means that the amount that you pay in capital gains is very likely to place you in a higher tax bracket. Think of it like having a bucket of water, and your employment income fills the bucket halfway. Any additional income adds water to that bucket, whether it comes from a second job, dividends, rental income, or capital gains. Whatever level it fills up to is what you pay taxes on, so save your receipts. Now I will say from my own experience that if you're willing to put in the hard work, accumulating 4 rental properties is not that difficult. I was able to achieve it with a lot of hard work and determination by the time I reached 30. And it is true what they say that the second million is a lot easier. This was done through something called delayed gratification, and what that simply means is that I was willing to do what the average person typically didn't want to do, so that I can enjoy things later in life that other people may not necessarily be able to enjoy. So why haven't I retired yet? Well, quite simply, it's because I chose to dramatically increase my quality of life. Why settle for $4,000 a month? Why not $13,000 a month? Why not $25,000 a month? Why put a cap on it at all? What I want to do is I want to ensure generational wealth. So I don't want to just make sure that I'm well off. I want to make sure that my kids and my grandkids are well off. And while I know that real estate isn't getting any cheaper, why not pursue my real estate acquisition to increase my real estate portfolio while I still have years to do so? And there's nothing wrong with that, provided you're willing to do the hard work. To see a real life example of what this actually means is, let's suppose I make $4,000 a month, $2,000 a paycheck, and I have a rental property that generates a positive cash flow of $1,000 a month. I would need to own 4 of these rental properties, and that would offset how much I make from my regular source of income every month. Now let's return back to the stock market. The lack of security in the stock market makes it a very risky place to park your money. If you're investing in the stock market for short term, then you're likely to either see big losses or big gains. Now, some people are engaged in what's called day trading, and that's where you're constantly trying to beat the market on a daily basis. In either case, you're gambling. You have no control over what the market's going to do, and therefore you have no control over what the outcome is. Rental properties are known to be what's called a hedge against inflation, and that's because when prices rise, real estate prices rise with it. You may have heard your parents talk about how back in their day, coffee at McDonald's was 10 cents, and now it's $1.80. That's inflation. The same way back in those days, you could purchase a house for approximately $80,000, whereas today it might be worth $300,000 or higher. Now let's suppose that you retire at the age of 65, which in Canada is the same age that your old age pension kicks in. And let's suppose that you live until you're aged 85. Now that means you have 20 years in retirement in where your pension needs to cover you. Hypothetically speaking, what would happen if you wanted to retire at the age of 40? Would you have enough pension money to see you through? It's quite unlikely. So why is that the case? Well, quite simply, you haven't worked long enough for your annual contribution towards your pension fund to kick in and provide those lasting benefits. And if you're banking on the stock market to retire at age 40, you would have had less time, and therefore you would have had to start off with a substantial amount of more money. And what happens if you live a lot longer than you were expected to? Do you have enough money to survive those additional years? What happens if you require medical care that's not covered by the government, such as in-home medical care or 24-hour nursing care? Now, when I'm talking to people about these sort of problems, and even people my age, I find that they're not thinking about these problems until way later in life, and by then, your choices reduce dramatically. You see, here's the problem. Retiring at a young age means that your money did not have enough time to grow to a higher amount than if you worked or invested for the long term. Here's some numbers for you. As of 2022, if you wanted to receive $4,000 from the stock market on a monthly basis, you would need $1.4 million invested in the stock market today. Now, if you're a real estate investor and as of 2022 you have $1.4 million to invest into the real estate market, you should be realizing profits of a minimum of $21,000 a month. Or in other words, $250,000 per year. And if you're not, then you're doing something terribly wrong. Now, this video is not designed to go into exactly how and so on and so forth. There are other videos on my YouTube channel for that. However, this is just to give you a comparison between the real estate market and the stock market. Now, when you compare the returns from the stock market with the real estate market, there is some truth that historically the returns from the stock market have been higher. However, this primarily only applies if you purchased your principal residence with 100% cash. Now, experienced real estate investors would never purchase a real estate property with all cash and just let the cash sit inside the property, especially if it was our principal residence. When we invest for cash flow, we invest for tax advantages. Most of us, under normal circumstances, don't even invest for appreciation. Now, if the price of the property goes up over a period of time, which is probable, then hey, that's great. But that's not primarily the reason we purchase investment properties. Real estate investors purchase an investment property with the minimum amount down, and then they leverage, i.e. borrow the rest. 25 years later, they own everything. Can you say that about the stock market? And let's not forget, when we put the minimum amount down, it completely distorts the returns between the stock market and the real estate market. Real estate investors save thousands of dollars every year through tax advantages. And let's not forget that we're often able to purchase properties below market value. Can you say that about the stock market? Just consider the fact that with the stock market, an investor has to put the whole 100% down, and the next day has absolutely no control over how profitable the company is going to be. With real estate, an investor can purchase a property with as little as 5% down, and over the course of the next 25 years, that 5% will generate the remaining 95%. And if it's purchased in a good area, it's very likely that it will increase in value. If an investor wants to increase returns, then within reason, he or she could perform several upgrades to the property and increase rent as a result. Once the increased rent covers the cost of those repairs, moving forward, the rest is profit. I will point out that if you're a stock market investor and you have a margin account, then technically speaking, you could get a loan up to 50% the value of your investment. However, once again, compared to the real estate industry, where you could leverage 80% and in some cases up to 95% the value of the asset, it's clear that with real estate you need less capital and can achieve bigger results. This actually creates a win-win situation for both the investor and the lender. An investor wins by leveraging up to 80% of the value of the asset, and the lender is eager to lend the 80% because they win off of the interest that is paid to them from the loan. Meanwhile, the investor hands over all of that debt to the tenant and gets the tenant to pay off a majority of that debt, if not all of that debt, through their monthly rent. Another history lesson here, stocks have been and can be artificially manipulated. Just think back to what occurred in 1717 with the Mississippi Bubble, which was the largest financial crisis of 18th century Europe. To serve as a quick recap, in 1717 the Mississippi Company, which was located in France, intended to colonize the Mississippi Valley. By doing so, the city of New Orleans was created in the process. The Mississippi Company needed to acquire money for this quest and decided to sell shares on the Paris Stock Exchange. Conveniently, Mr. John Law, who was the company's director, also held a position as governor to the Central Bank of France. Thinking back to those times, only a few people knew that the Mississippi Valley was just an alligator-infested swamp. Of course, this is not what the Mississippi Company portrayed. They portrayed the Mississippi Valley to be this beautiful place with riches beyond your wildest of dreams, and everybody from extremely wealthy noblemen to your average citizen believed these tales. This inevitably drove the price of shares up. Just think demand and supply. The price of one Mississippi share started at 500 livres, and within just a few short months climbed up to as much as 10,000 livres per share. The French people went nuts. They were selling off all their valuables and seeking out loans just to buy a Mississippi share because they believed that they found a shortcut to success. Unfortunately, you may know where this is headed. Fear and panic set in, and many people attempted to quickly sell their share or risk losing a small fortune. Of course, as the shares were sold, the supply increased. As the supply increased, the price per share decreased. As the price per share decreased, more and more people wanted to sell their shares. People could not dump these stocks fast enough, and a drastic fall in prices began. Mr. John Law, on behalf of the Central Bank of France, thought that if he purchased all these shares, he would encourage others to believe that they were still worth something. However, this strategy served to be unsuccessful because of the price per share, and as a result, the Central Bank of France went broke. And when the Central Bank of France went broke, the same John Law decided to start printing money in efforts to purchase all the remaining Mississippi shares. However, in doing so, the entire French economy was compromised. Ultimately, the price of a Mississippi share dropped from its peak of 10,000 livres down to just 1,000 livres before ultimately being rendered worthless at 0 livres per share. By this time, the Central Bank of France and the Treasury owned a majority of these worthless shares, and if that wasn't bad enough, they paid a fortune for it. Those who were lucky enough to get out in time were not affected as much. However, there were a lot of people who lost everything, and as a result, there was a significant increase in suicide rates. This market crash ultimately created ripples, and thus led to the beginning of the French Revolution. Okay, now history lesson over. The stock market is volatile, which means it has the ability to go up in value and down in value from week to week or day to day, and even from hour to hour. One day, you could be holding onto a paper statement suggesting your stock is worth thousands of dollars, only to wake up the next morning and find out that it's not even worth the ink on it. Real estate, on the other hand, even though the market can go up and down, the cost of real estate and other properties are not as volatile as the stock market. And even so, the rental price on real estate is even less likely to be affected. Here's another way to look at it. During the 2008 financial market crash, which took place from September to October 2008, the Dow Jones fell 3,600 points. But the rent for my rental properties didn't even fluctuate the least. Tenants didn't vacate their rental properties. Investing for the long term through my rental properties, if I did lose any value, it was only on paper, and it really had no effect on me. The same way it didn't have an effect on other like-minded investors, and that's because we invest for cash flow purposes and not appreciation. Those, however, who did invest for appreciation or prior to the 2008 market crash didn't believe in rental properties certainly did feel the pinch. Many unfortunately did lose their assets and unfortunately did have to be foreclosed on. Now, don't get me wrong, I sympathize for those who lost any of their assets in the process. Ultimately, it was the greedy rich that really crashed down on the rest of society. However, it's poor planning and poor understanding that puts us often at times in these vulnerable positions. And that is the purpose of making these YouTube videos, is to help you so that you can possibly prepare for these unexpected events, and in the event any uncontrollable events come your way, it can certainly help soften the blow. Now, instead of looking at real estate versus the stock market, I encourage you to ask yourself, why not both? There's money to be made in real estate and there's money to be made in the stock market. If you're interested in investing into the stock market, my suggestion to you would be consider diversifying your investments. Enter the real estate world and get your feet wet. By bringing in positive cash flow, you may decide to use some or all of that positive cash flow to invest in the stock market. Now, there's obviously a plus side investing in stocks. After all, if you invest smartly and in the right companies, there's an opportunity to make great fortunes. AT&T, for example, offers 5% dividends, ExxonMobil offers 8.7% dividends, and Iron Mountain offers 9% dividends. If you were to take out equity in your home to invest in stocks that consistently do well on the S&P 500, there's opportunity to retire quite comfortably. With $2 million invested into Iron Mountain in 2021, you would see an annual return of $180,000. Now, you might be thinking, where does that $2 million come from? Well, you could take out the equity in your real estate portfolio so that you're not actually dipping into any of your cash reserves. The returns would pay the borrowing cost of 1%, leaving the remaining 8% or $160,000 as profit. And the interest that you pay to service that $2 million loan can even be tax deductible if structured correctly. Talk about a win-win-win, but what makes it all possible? Real estate. Purchasing 2 properties today in a great location at $500,000 each is almost guaranteed to be worth $2 million 30 years down the road when you're perhaps a little bit closer to retirement. Thank you guys for taking the time to watch my video. I hope you liked it and I hope you learned something. If you did, hit the like and subscribe button down below. It helps me to grow my channel and continue putting out great content for you guys. Leave me a comment in the comment section below. I'd love to hear from you.